The stock market is currently closed, and the last reported closing price for BigBear Holdings Inc., ticker symbol BBAI, was $6.27 per share on Monday, November 24, 2025, which represented a substantial gain of 16.11% on heavy volume of over 92 million shares for that session. Now, the immediate expectation for a stock that jumps over 16% in a day, especially in the high-volatility AI sector, is a simple continuation of momentum, driven by retail euphoria and a general AI is everything narrative. But the reality is far more nuanced and perhaps more telling. That enormous spike was catalyzed not just by the positive Q3 earnings beat on the bottom line, but by a very specific and strategic $250 million acquisition of Ask Sage, a generative AI platform with a strong foothold in the government and defense client base. This move is the deeper, more significant story here. It's an aggressive, financially demanding maneuver that immediately shifts the business profile toward higher-margin, secure government AI contracts, which is exactly the kind of move the institutional money looks for to validate a smaller, high-growth, but often cash-burning operation. The narrative that BBAI is simply a meme stock benefiting from generalized AI hype is being seriously challenged by management's calculated push into the high-security, high-barrier-to-entry defense sector, which provides a much more defensible and sticky source of future revenue than many of their commercial peers. This tension between the fast-trading, emotionally driven retail expectation and the deeper, strategic reality is where the true investment analysis must begin for BBAI. The recent price action has been a classic illustration of this battle between expectation and reality. Leading up to the November 10th Q3 earnings report, the stock had been trading in a relatively tight range, perhaps reflecting the market's common belief that BBAI was still too dependent on lumpy government contracts and was struggling with profitability. The announcement delivered a top-line revenue figure that was technically down year-over-year by about 20% due to lower volume on certain U.S. Army programs, but crucially, the reported net income was a positive $2.5 million, a significant swing from a net loss in the prior year, primarily due to non-cash derivative revaluation gains. The market's initial expectation was focused on the revenue decline, which would typically cause a sell-off. But the reality of the net income beat, even if driven by accounting adjustments related to convertible notes and warrants, combined with the massive strategic value of the Ask Sage acquisition, sent the stock soaring. The company explicitly raising guidance, targeting an annual revenue range of $125 to $140 million, also acted as a powerful counter-narrative to the revenue drop, suggesting that the near-term dip was transitory while the long-term growth story, buttressed by the new acquisition, remains intact. This explosive reaction highlights a common factor in today's volatile market. Investors are willing to overlook short-term revenue softness if the strategic direction is aggressive and directly aligned with the most powerful secular trends, in this case, defense-grade generative AI. This high volatility and aggressive strategic positioning also bring us directly to the issue of short selling, which is extremely relevant for BBAI. The latest data available indicates that BBAI is indeed under notable short seller pressure. The short interest stood at approximately 79.4 million shares, which translates to a high short interest percent of float, around 18.32%. This level signals a significant number of bearish bets against the company. The short thesis, which is prevalent in discussions on finance forums, is relatively straightforward. The company's valuation, with a P/sales ratio sitting around 17x to 19x, is seen as excessive for a firm with fluctuating revenue and persistent negative adjusted EBITDA. The bears look at the revenue decline in Q3, the use of non-cash gains to achieve net income, and the large stock-based financing for the Ask Sage acquisition, and they argue that the company is overvalued hype that will eventually correct back down to single digits. They are betting on the fundamental financial metrics, taking precedence over the strategic narrative. The actionability here for a retail investor lies in monitoring the days-to-cover ratio, which currently sits at a very low 0.87 days. This figure, calculated by dividing the short interest by the average daily trading volume, suggests that the short positions could theoretically be covered very quickly. A low days-to-cover number actually reduces the immediate risk of a major short squeeze, as the short sellers are not overly trapped and have an easier exit strategy if the price moves against them. However, the short borrow fee rate, though recently low at around 1.04%, is a data point that can spike without warning, especially following a major price increase like the one on Monday. An investor must watch for a sharp increase in this borrow cost, as it signals rising demand from short sellers who are either initiating new positions or doubling down on their existing ones, which can precede either a concerted short attack or, conversely, the preconditions for a squeeze if a major catalyst hits. This is the constant push and pull. We also see evidence of high off-exchange short volume, sometimes exceeding 30% of the aggregate volume, which speaks to a coordinated, high-frequency trading element in the shorting activity. Retail investors can monitor FINRA data for this off-exchange volume to get a fuller picture of the selling pressure. In terms of institutional activity, the movements are mixed but leaning positive, which counters the short thesis. The most recent filings show a significant increase in institutional holdings. The Vanguard Group added a substantial number of shares, increasing its position by over 32%, and BlackRock Inc. also added nearly 18%. This institutional buying, the smart money, suggests a belief in the long-term value creation from the Ask Sage deal and the defense-focused strategy. Conversely, certain hedge funds like Citadel Advisors were seen decreasing their positions, which indicates that not all large players agree on the valuation post-acquisition, likely aligning with the skepticism of the short sellers. This institutional divergence is a healthy sign of a stock in transition, not a unified stampede in one direction. It forces a more thoughtful approach, moving beyond simple sentiment. To understand the core business reality behind all this trading, BigBear operates as an artificial intelligence provider, focusing specifically on what they call decision intelligence. Their solutions combine predictive analytics, machine learning, and secure data fusion to help clients, primarily in the U.S. national security and defense sectors, make faster, more informed decisions. Think of it as a platform that takes massive, disparate datasets, satellite imagery, sensor data, intelligence reports, and uses AI models to identify patterns and predict outcomes, giving an edge in complex operational environments. Historically, this is translated into large multi-year contracts, leading to the high backlog number, which was last reported at a solid $376 million. The issue has always been the conversion of this backlog into high-margin revenue on a consistent basis, especially since the government contract cycle can be notoriously lumpy and subject to delays or shifts in funding. This is where the Ask Sage acquisition comes in. It's a generative AI solution built from the ground up to handle high-security data, directly addressing the massive push for secure, private-instance generative AI within federal agencies. This move significantly elevates BBAI's offering from basic predictive analytics to a cutting-edge generative platform, which is a major differentiator in the defense market. Looking ahead, the future outlook for BBA is tied to three main catalysts. First, the seamless and rapid integration of Ask Sage. If they can quickly cross-sell this new generative AI capability to their existing defense and intelligence client base, the company will have significantly de-risked its revenue stream. The second, the shareholder meeting scheduled for December 1st, is a near-term event that will keep the stock in the spotlight. While it is likely focused on standard corporate governance matters, any unexpected announcement or management statement on the new strategy will create movement. The third and arguably most important factor is the macro environment for defense spending, particularly the sustained focus on AI-driven capabilities within the DoD and other federal agencies.
With continued geopolitical tensions, the government's need for real-time decision intelligence is not diminishing, which provides a secular tailwind that fundamentally supports the long-term growth thesis, overriding short-term contract delays. The risks, of course, are numerous. The massive dilution of shareholders over the last year, largely due to SPAC and financing structures, is a major headwind that keeps many value investors away. The stock is currently trading at a price-to-book ratio of around 4.5x, which, while not unheard of for a high-growth tech stock, is a valuation metric that short sellers love. The company must deliver on its improved gross margins and adjusted EBITDA guidance in the coming quarters to justify this rich valuation. A miss on Q4 or Q1 earnings, even a slight one, could be severely punished due to the already elevated short interest and the high expectations set by the Ask Sage acquisition. In the social media echo chamber, there's a strong current of sentiment, particularly